How does a company that loses money on almost every single product it sells keep getting bigger, keep getting more valuable, and somehow keep not dying? OpenAI loses $575,000 per hour. Not per month, not per day, per hour. Every hour, around the clock, 7 days a week. Right now, as you watch this video, OpenAI is losing $95,000. In 2024, the company behind ChatGPT lost $5 billion. That's more than most companies ever make in revenue. And yet, just a few months ago, investors handed them $122 billion more, the largest private funding round in history. In this video, we're going to follow the money. You'll see exactly where it comes from, where it goes, and why the people writing these checks are not crazy. And at the end, I'll tell you what this whole thing is really a bet on, because it's not what most people think. The investigation, the financial paradox. To understand how OpenAI stays alive, we have to investigate its finances, and the numbers are staggering. First, let's talk about the burn rate. In 2024, OpenAI generated an impressive $3.7 billion in revenue, but it reported a net loss of approximately $5 billion. Projections for 2026 see revenues growing significantly, but some analyses show losses could balloon to a jaw-dropping $14 billion. So where does it all go? The single biggest cost is inference. Think of it like a utility meter that's constantly running. It's the immense computing power required every time one of its roughly 900 million weekly users types a prompt into ChatGPT. A huge portion of those users are on the free tier, meaning for every poem, email, and piece of code they generate, OpenAI is footing the bill. It's like running a taxi service where the meter is always running, but most of the passengers are riding for free. These inference costs are a primary driver of the company's expenses. Then, there's the cost of innovation. Training a cutting-edge model like GPT-4 was estimated to cost over $100 million in compute power alone. Think of that as the cost to design and build a single, perfect master key. Newer, more powerful models cost exponentially more, with some estimates for models like GPT-5 and beyond soaring past $500 million just for one single training run. Add to that the war for talent, where top AI researchers command salaries well into the millions, and you have a financial furnace that consumes billions. This brings us to the revenue paradox. OpenAI's growth is, by any normal measure, historic. The company went from just a few $1 million in revenue in 2020 to an annualized run rate of around $20 to $25 billion by early 2026. That is one of the fastest growth trajectories in tech history. But it's still not enough. The fundamental problem is that OpenAI's business model is not like selling software. For a company like Microsoft, once a program is built, the cost to sell another digital copy is almost zero. For OpenAI, every single use of its product costs real money. It's like a delivery service where the more packages you deliver, the more you spend on gas. And right now, the cost of gas for each delivery is more than the customer is paying. This is a variable cost that grows right alongside its revenue. And as long as the cost of running the models outpaces the money coming in, the company will continue to lose billions, no matter how fast it grows. The company itself doesn't expect to be cash flow positive until 2029 or 2030 at the earliest. The reveal, the benefactors. So, if OpenAI is a leaky bucket pouring out more cash than it can bring in right now, how is it still standing? This is where the mystery unravels, and we meet the benefactors. The machine that keeps OpenAI alive is a relentless fundraising engine. To date, OpenAI has raised over $180 billion in capital, a figure that includes a landmark $122 billion round in early 2026. To put that in perspective, that is more than the total amount of venture capital raised across entire continents in some years. The most important benefactor, of course, is Microsoft. Starting in 2019, Microsoft has poured over $13 billion into OpenAI. Now, this isn't a simple investment for a chunk of the company. It's a deeply strategic and complex partnership, following a corporate restructuring Microsoft holds a stake of around 27% in OpenAI's for-profit arm. This gives Microsoft deep access to OpenAI's most advanced models, which it has integrated across its entire product line, from Windows to Office to its Azure cloud platform. But the cash infusions go far beyond Microsoft. In that landmark event in early 2026, OpenAI announced it had closed its $122 billion funding round with backing from giants like SoftBank, Amazon, and Nvidia. Think about that. Some of the company's biggest competitors are now also its major funders. This isn't just an investment. It's like rival airlines all chipping in to fund the one company that's building the next generation of jet engines because they all want to be first in line to use them. It's an entire industry placing a coordinated bet that OpenAI is too big and too important to fail. The climax, the high-stakes gamble. This brings us to the real story. The billions being poured into OpenAI aren't about making a profit on ChatGPT subscriptions. That's just the tip of the iceberg. The real endgame is a high-stakes gamble to build and own the fundamental infrastructure of the next technological revolution. Investors aren't looking at OpenAI as a simple software-as-a-service company. They're looking at it as the 21st century equivalent of the railroads. In the 19th century, building railroads was astronomically expensive. Most of the original railroad companies went bankrupt, but the industrialists who ultimately owned and controlled the tracks held the keys to the entire American economy for decades. This is the bet on OpenAI. The wager is that artificial general intelligence, or AGI, will be the foundational layer for everything that comes next. The company that builds the most powerful models and the infrastructure to run them will become the new gatekeeper of the digital world. In that scenario, losing billions of dollars today is just the construction cost for a monopoly that could be worth trillions tomorrow. This strategy is often compared to Amazon in the late 1990s. For years, Amazon famously lost money. Wall Street was screaming that the company was a house of cards. But Jeff Bezos wasn't building a bookstore. He was building a global logistics and e-commerce empire. The losses were a deliberate investment in capturing the market and building a moat so wide that no one could ever cross it. OpenAI and its investors are running the same playbook, but on a scale that makes Amazon's early days look quaint. There's even a bizarre, almost circular financing loop that highlights the scale of this bet. It's like a self-contained ecosystem designed for rapid growth. You have chip makers like Nvidia investing billions into OpenAI. OpenAI then uses that money to sign massive deals with cloud providers like Oracle, who in turn buy billions of dollars worth of chips from Nvidia to build out their data centers. It's a closed system where capital is recycled to rapidly build the infrastructure needed to secure market dominance before anyone else can catch up. But here's the crisis point that nobody talks about openly. OpenAI's own internal projections show losses growing to $74 billion in a single year by 2028. Before the company turns cash flow positive around 2029 or 2030. Between now and profitability, they need to raise and spend somewhere between $115 and $143 billion more. And one estimate puts the total funding gap at $207 billion, even if everything goes according to plan. The unresolved ending. What's next? So, will this high-stakes bet pay off, or is it the epicenter of the next great tech bubble? The risks are enormous. OpenAI is not alone in this race. Its rival, Anthropic, is also raising tens of billions of dollars. And then, you have the established giants. In 2026 alone, companies like Google, Meta, and Amazon are projected to spend a combined total that could approach $700 billion on their own AI capital expenditures. The entire industry is all in on this cash-burning gamble. There is a very real possibility that the funding could dry up, that a competitor could achieve a breakthrough that renders OpenAI's models obsolete, or that regulatory hurdles could stop this train in its tracks. Some analysts project OpenAI faces a massive funding shortfall to reach profitability by 2030, a gap that must be filled by ever more believing investors. However, the momentum is undeniably on OpenAI's side. With a valuation soaring over $850 billion after its latest funding round and the backing of nearly every major player in technology and finance, the company has the resources to continue its strategy for the foreseeable future. The investors are betting that owning the AI railroads is a prize worth any price. They believe the eventual payoff will not just be profitable, but will redefine the global economy. In the end, OpenAI's story is a financial paradox. It's a company that is both wildly successful and catastrophically unprofitable, all at the same time. It survives because its backers aren't investing in its present, but in its potential to own the future. The question we are all left with is a simple one. Are we watching the brilliant, long-game construction of the next Amazon, an entity that will become the indispensable infrastructure of our world? Or are we witnessing the most spectacular and expensive tech bubble in history inflate in real time, just waiting for a pin? The next few years will deliver the verdict. If this video changed how you see OpenAI, drop your answer in the comments. Do you think OpenAI makes it to 2030? And if you want more videos like this, hit the like button and subscribe. It genuinely helps this channel grow. Thanks for watching.